Have you ever wondered when is the best time for you to retire? A lot of people pick the wrong time to retire, the wrong age. And in the next few minutes, I will show you how to avoid these same mistakes and retire at the right time. And make sure to stay to the end of the video where I show you exactly how to calculate when you can safely retire and not worry about running out of money. If you select the wrong age to retire, it could result in a loss of your financial independence, being forced to unretire, or make severe cuts in your retirement lifestyle. In other words, you could run out of money 10 to 20 years into your retirement.
Oh no!
I want you to avoid those hardships. In retirement forums I visit online, I see a lot of comments from people who retired based on one of the following. Some people say they got laid off and so they figured it was just time to retire. But the question is, can they afford to retire? They didn't ask that question and they end up paying the price later. Other people say they retired for health reasons, but does their health keep them from working at a work-at-home job, which are very plentiful right now? Again, the all-important question is whether or not they can afford to retire. And if the answer is no, they have to find an alternative for income. We talk about a few alternatives for people facing that problem, and we'll leave some links in the description below the video. And by the way, make sure to subscribe, the subscribe button below, and hit the bell icon when it appears. This way, when we publish new ways to help you win your battle for retirement, freedom, and independence, you'll hear about it.
Some people retire because their stocks double in value from the beginning of the pandemic until the end of 2021. So they felt rich and they decided to retire. However, if their stocks doubled in value in less than 2 years, their stocks can also fall by the same amount in an even shorter period of time. Other people retire because they looked at the value of their house and said, hey, I'm rich, why not? But unless they sell their house and convert that value to assets that produce retirement income, their house value can decline and all that apparent wealth can very quickly disappear. Some people retire because at age 62 they can claim Social Security benefits. Of course, the benefits will be reduced by 30% by claiming at such a young age, as Larry explains.
Here's the way Social Security works. If you were born 1960 and later, you'll get your full Social Security benefits at age 67. But if you retire at age 62, you'll lose 30%.
In all of these cases that we just highlighted, people overlook the one important issue when deciding to retire, which is this: can you afford it? Specifically, do you have sufficient income to cover your current and future expenses?
While this is so obvious to determine if you can afford to retire, it appears to be overlooked by huge numbers of people who base their retirement age on something other than the all-important question, can you afford it? So how do you know if you can afford it? Some people hire a financial advisor who has sophisticated software that can analyze your current financial condition and make projections into the future and then tell you at what age you can afford to retire. That's probably the best way to get the right answer to the age at which you can afford to retire. If you want a simpler approach, I can suggest the following. For a month, you must track every penny you spend and write it down. In my case, since I never use cash, everything I spend either shows up on my bank statement or my credit card bill. I can simply download my credit card statement and my bank statement detail to its spreadsheet like this. Now, you can do this exercise with any spreadsheet like Microsoft Excel or Google Docs or any other spreadsheet program. I downloaded all my transactions from my bank account, my bank statement for 1 month, and my credit card. So I have everything I spent for the entire month. I then divided it into columns so that I could adjust, for example, if I think that I'll be eating out more in retirement than I eat out now. I could adjust this food level up or down because I can that way adjust my expenses from when I'm working to what I plan to spend when I retire. So now that I have all of my expenses, I'm able to take those totals and see, well, there's what I spent for the month of February 2020, then I can compare those expenses to my retirement income sources and see, do I have enough to retire or not at my planned retirement date?
But that number you determined for your expenses, it's really not a fixed number. Why is that? Because over time, things get more expensive. The price of food will go up, your property taxes will go up, and the cost of vacations will go up, etc. Therefore, you have to multiply your monthly expenses by 1.3 or more to get an approximation of your real costs. For example, if you calculate your monthly expenses to be $5,000, you need to multiply that by at least 1.3 to come up with $6,500. Now that you know what you spend, you need to answer the next question. Will my retirement income be $6,500 a month? In addition to rising costs, there's another reason that you have to multiply your expenses by a factor of 1.3 or more, which is to cover unplanned expenses like replacing the roof on your home, or, for example, unforeseen dental problems, or the need to replace a car that you thought would last for 20 years, but doesn't. To think that those unplanned events won't happen to you is unwise, or maybe even a little foolish.
I think not.
Remember, this little bit of planning now saves you from a financial catastrophe in 10 or 20 years from now.
Now let's figure your income. Add together your interest income, your dividends, your Social Security and your pension, and any other certain sources of income. I say certain sources of income because a high value of your stocks or high home value does not give you a certain stream of income until you convert those assets into assets that provide a certain stream of income. For example, if you have a portfolio of stocks that did not pay any dividends, you cannot rely on that stock portfolio for any income unless you implement the strategy we talk about in our video, how to use stocks and stock mutual funds to create retirement income. You could either use that strategy explained in that video, or you would need to convert those stocks to bonds or a retirement annuity that makes fixed payments every year. Then you could count on those assets for a specific amount of annual income. Similarly, just because your house is worth a lot does not provide retirement income. Your house can fall in value. Until you sell that house and reinvest your profit, you cannot rely on your home value as a source of retirement income.
Now, if you notice that your retirement income will not cover all your expenses, you have a few choices. For example, you can either plan to cut spending or earn some side gig income or delay your retirement. One choice you don't have is to ignore the reality and retire anyway. The people who do that end up in trouble. We talked about that a little earlier. If you decide to delay your retirement, you'll potentially enjoy quite a few benefits. It gives you time to do the following. First, you'll have time to add more money to your retirement accounts, and that larger amount can be then invested to generate additional retirement income. Second, you can file for Social Security at a later age because you get a whopping 77% more by filing at age 70 than at age 62.
Genius!
Third, you can reduce your expenses by possibly moving to a less expensive place. That could also release home equity that you can then invest for retirement income. And fourth, you can adjust your plans for retirement. As an example, more and more people are, especially retirees, are cohabitating because sharing a home, utilities, and maintenance expenses can be a huge savings. We've given you a simplified approach to answer the question, at what age can you afford to retire? I say that it's simplified because the most important idea is the concept that the age at which you can afford to retire is when you are certain to have income sources that will pay for your current and future expenses. Remember that retirement lasts for 20 or 30 years, hopefully. So let's recap. The right time to retire doesn't depend on things like the fact that you got laid off at work, or the value of your stocks, or the value of your house, or the fact that maybe you've reached age 62. The right time to retire is when you know that your retirement income covers your current and future expenses. And until you do the exercise that we just went through, retirement has a high chance of being a painful event and likely forcing you to return to work. Make sure to subscribe and hit the notification bell, and you'll be notified about future ideas we want to share with you about securing your retirement future. Also, if you have a question, please leave that in the comments below. We read and respond to every comment, and we look forward to connecting with you soon.